All right, settle in. Welcome to the deep dive. You've shared some material with us, FAQs, articles, all focused on construction loans, specifically for veterans using their VA benefits to build a home. So today, we're going to really dig into that stack you sent over.
That's the plan. We're aiming to take all that info and kind of cut through the complexity, pull out the really crucial bits, the steps you need to know, maybe some surprising details hidden in there. Just make it all easier for you to understand.
Because building a home from scratch, that's the dream, isn't it? But financing construction, that often feels like a huge hurdle. Our mission today is to map out the path described in your sources for veterans, focusing on this thing called the VA one-time close construction loan.
Yeah, and the name itself, One Time Close, kind of gives away a big part of the story. We'll unpack exactly what that means, how the process works based on this material, and like you said, highlight some really unique things mentioned. Stuff like potentially building with zero down payment or this interesting rate advantage. It's all in the documents you shared.
Okay, let's jump right in then. Thinking about building a new house, the traditional way seems to involve multiple loans, right? Like one for the land, another for the actual building,
Right.
and then another mortgage once it's all done. That sounds, well, complicated.
It absolutely can be. And that's exactly the headache the VA one-time close, as it's laid out in this material, is supposed to fix.
So it collapses all those steps into one single loan.
Precisely. Yeah. Think of it like one package deal. It covers buying the plot of land. It funds the entire construction process, foundation to rooftop, and then, bam, once the house is finished, it just becomes your permanent mortgage.
One loan, one closing. That alone sounds like a massive benefit. Saves time, paperwork, probably fees too, compared to closing 3 different times.
Oh, definitely. It streamlines things significantly. And maybe the biggest headline grabber in the info you sent, especially for eligible VA borrowers, is the potential for zero down payment.
Wait, zero down to build a brand new house? That's pretty incredible.
It really is, especially when you compare it. Conventional construction loans, they usually demand, 5%, maybe 10%, sometimes even 20% down. But for veterans using this VA option described here, the material highlights this possibility of financing the whole thing land and build with nothing out of pocket up front. That's huge.
Okay, wow. So we get the single loan covers everything, potentially zero down. How does it actually unfold? What are the steps involved according to this material?
So the process laid out starts, logically, with getting pre-approved or qualified. That's step one. And it's really important because this determines your total loan amount, which needs to cover the land cost, the build cost, and the interest expected during construction.
Gotcha. So that number covers everything needed for the project. What's next after you get the green light on the loan amount?
Then you find your land. But there's a key rule here from the sources. The land has to have utility access: water, power, sewer, or septic approval. The material is very clear. This loan program doesn't cover what they call raw land or fully off-grid homes. It needs to be ready to build on and connect.
Okay, that makes sense. You need utilities for a modern home.
Right. Land secured. Next up is the builder. This is critical. The loan requires you use a licensed third-party builder. The sources stress this. You cannot be your own builder on this type of loan. It's not allowed due to program rules. And this builder, they need to be VA registered and approved by the bank actually doing the loan.
Bank approval for the builder, too. How much time does that usually add?
The info you provided says it's usually pretty quick, maybe 3 to 5 business days. Depends on how fast the builder gets their paperwork submitted,
All right. Qualify, find suitable land, get the right builder approved. Then comes the big moment, that single closing.
That's it. You sign the documents one time. That single session legally buys the land, locks in the construction funding, and sets up the loan to automatically convert to your permanent mortgage later on.
And then the fun part starts watching the house go up. How does the money flow to the builder during construction?
Good question. It's done through what are called draws, basically installments. As the builder hits certain milestones, say, the foundation's done, then the framing's up, then the roof is on, they request a draw payment for the work completed.
Okay, but how do you know the work is actually done right before they get paid?
Built-in protection, that's key. Before any draw money is released, an inspection happens. These are done by independent VA-compliant inspectors. They verify the work matches the plans and meets standards. Then the funds are released. It ensures the builder gets paid for work actually completed.
That's a really important safeguard for the homeowner. What about interest payments during the build? How does that work?
So this is interesting based on the sources. The general rule for construction loans is you pay interest only on the money that's been drawn out so far, not the whole loan amount. However, one of the sources you sent specifically states that for this lender's VA construction loan program, veterans pay 0 interest during the construction period. Full stop. That's presented as a specific benefit they offer.
Whoa, hold on. 0 interest while it's being built. That's definitely different and a huge plus.
It certainly stands out in the material. And then once the house is finally finished, keys ready. That's when the one-time close really shows its value. After a final inspection confirms everything's built to VA standards, the loan just automatically rolls over into your permanent VA mortgage. No second closing, no reapplying, no more stacks of documents just to finalize the loan. It just converts.
Seamless. Okay, that smooth conversion and the 0 down are definitely big draws. Let's dig deeper into the benefits outlined in the material. What else makes this loan appealing for veterans?
Well, we've hit the big ones. That potential 0 down payment, which is just massive for qualified folks, and the single closing, saving you time, money, and headaches compared to juggling multiple loans.
Right. And we touched on interest rates. Anything else special there besides that potential 0 interest during the build phase?
Yes, this is another really neat feature highlighted in the sources. They call it the rate conversion advantage. See, with a lot of construction loans, your final mortgage rate gets locked in pretty early on, maybe even before construction starts. But with this VA one-time close, the material says you actually select your final permanent interest rate right before you move in.
So let me get this straight. You build the house over, say, 9 months. If market rates happen to drop during that time,
You could potentially lock in that lower rate just before closing out the construction phase.
exactly. It gives you flexibility. The sources also mention there's an interest rate cap, sort of a safety net, just in case rates were to spike dramatically during the build. So you have protection on the upside, too.
That flexibility is really valuable, giving you a shot at the best rate. And generally, how competitive are VA loan rates?
The material suggests they're usually very competitive, often lower than conventional rates, maybe by 0.25% to 0.5%, according to one source. And the permanent rates you get after construction, they're stated as being the same as standard VA purchase loan rates. Plus, a standard VA loan benefit. No private mortgage insurance or PMI.
Correct. That's always a plus with VA loans. Saves you money compared to conventional loans with less than 20% down, or FHA loans, which always have mortgage insurance.
What about credit scores? Are the requirements really strict?
The info mentions flexible VA guidelines. It specifically notes a minimum credit score of 620 or higher is typically required for this program.
Okay, 620 plus some. And project size. Can you only build mansions with this, or does it work for more average homes, too?
It seems pretty flexible. The sources say loan amounts generally start around $200,000. And currently, due to market conditions, they go up to the standard conforming loan limit, which is listed as $806,500. They do mention VA loans historically didn't have a limit for those with full entitlement, but this specific program adheres to the conforming limits right now. There's also mention of a jumbo option, a portfolio loan that goes up to $1 million if your project is bigger, but that one requires 15% down.
So $200K up to over $800K, potentially higher with a down payment. That covers a wide range.
It seems designed to cover a good spectrum of home building projects, yeah.
Yeah. Okay, let's switch gears to eligibility and the property itself. Who exactly qualifies for this loan, and what are the hard rules about what you can build based on this material?
Right, eligibility first. You need that valid certificate of eligibility, or COE. So you need to be a veteran, active duty service member, or an eligible surviving spouse. Then, like any loan, you need to show you have sufficient, stable income. And your debt-to-income ratio, your DTI, needs to meet the VA standards for this program. The sources mention generally under 41%, though they say exceptions are sometimes possible.
And the house itself, does it have to be your main home?
Primarily, yes. It has to be your primary residence. The material does note that financing a second home might be possible, but it would require a larger down payment. What's definitely not allowed with these specific construction loans, according to the sources, are investment properties. Pure rentals are out.
Got it. Primary residence and availability. Can veterans get this anywhere?
The lender mentioned in the material operates nationwide, offering these construction loans in 46 states. Their regular purchase and refi loans are in 48 states.
Okay, 46 states is pretty broad coverage. So, assuming you're eligible and it's your primary home, what are the absolute must-know rules about the property and the builder from these sources?
The finished property has to meet the standard VA minimum property requirements, or MPRs. Safety, soundness, that sort of thing. We already talked about the land needing utilities, no raw land. And the builder rule is a big one. Must be a licensed third-party builder who is VA registered and approved by the lender, cannot be an owner-builder situation, period. Only one main builder gets the funds.
That owner-builder restriction is definitely something to highlight. Now, the material you sent also has a pretty specific list of things you can't finance with this VA construction loan. What's on that no-go list?
Yeah, it's quite detailed according to the sources. No multi-unit properties, so no duplexes, triplexes, quadplexes. But there's an interesting exception noted for accessory dwelling units, ADUs, like a small granny flat or guest house. Those can be included if they meet very specific size rules, between 375 and just under 1,000 square feet, and they can't be more than 40% of the main house's floor area.
So a small detached unit might be okay if it fits squarely within those measurements.
Exactly. If it meets those size and ratio requirements, it seems permissible based on the notes. Okay, continuing the cannot build list from the sources. No investment properties, we covered that. No financing a home where construction has already started, like buying a half-finished project. It needs to be new construction funded by this loan. No tiny homes under 800 square feet, unless, again, it qualifies as an ADU under those specific size rules.
What about really unusual home types, things you see on TV sometimes?
The sources list several that are generally not allowed, often due to appraisal difficulties. Things like shipping container homes, true off-grid homes, geodesic domes, earth-sheltered or berm homes, Quonset huts, straw bale construction. Interestingly, they say timber frame homes are okay, but log homes generally aren't, and barn dominiums or pole barn homes. Those are mentioned as potentially okay if they can get a solid appraisal. So appraisal seems to be the hurdle for some unusual types.
That makes sense. If the appraiser can't confidently value it, the bank won't lend on it.
Precisely. A few other points from the sources. You can't use government grant money or down payment assistance funds with any of this lender's construction loans, VA, FHA, or conventional. But cash gifts from family are okay. Also, modular homes. Not allowed under this VA program, though the lender does finance them under FHA conventional, remodeling existing homes. Not with this VA or FHA construction loan, only their conventional one covers remodels. Manufactured or mobile homes are also out for these construction programs. And finally, swimming pools can't be financed as part of the VA or FHA construction loan package, only conventional.
Wow, that's a very specific list of exclusions. Good to know up front. What if the land you want has an old, dilapidated house on it already? Can the loan cover tearing it down?
Yes, the sources say demolition and removal costs, or even just significant land clearing, can be included in the loan. The catch is, the total cost, including the demo, can't exceed what the final appraised value of the new home and land will be.
Okay. And land size. Is there a limit on how many acres you can buy with the house?
The general limit mentioned is 10 acres. They might consider a bit more case by case with special approval, but basically the loan value is tied to the house and up to 10 acres. You couldn't say use this loan to buy a 50-acre ranch and just build a house on one corner, according to material. The value needs to support the whole package being financed.
Right. Keeps the focus on the primary residence build. Okay, that covers the rules. Let's talk practicalities, timelines. What should someone realistically expect, and what potential snags should they watch out for based on this info?
Okay, timing. Builder approval. Quick, 3 to 5 business days, we mentioned that. For the loan closing itself, the sources recommend allowing 45 to 60 days in your land purchase contract. They say it can be faster, maybe closer to 45 days, if the file is clean and the builder is already approved. And remember, that includes a mandatory 1-week waiting period after you get final docs before you can actually sign.
Okay, 45, 60 days to close. Then how long does the builder typically have to finish the house?
The standard construction timeline allowed is 12 months from the loan closing date. The sources mentioned limited 60-day extensions might be possible, but they cost extra.
And those payments to the builder, the draws, how frequently can those happen?
The material says draws can be requested and processed up to twice a month, and the funds are usually wired within 72 hours once the lender gets the signed request. Pretty quick turnaround.
Good to know. What about common mistakes? Pitfalls people should try to avoid? Anything the sources flag?
They do point out a few things. One is maybe not fully checking out the builder's credentials, although they note the bank's own approval process helps catch issues there. Another is underestimating the closing timeline. VA construction loans, they suggest, can sometimes take a bit longer than buying an existing house, maybe an extra month or two overall. You need to factor that in.
Yeah, patience is key with construction, seems like.
Absolutely. They also warn against skipping contingency funds. Although, interestingly, the sources state this VA program actually requires a 10% contingency buffer be built into the loan amount. The builder's supposed to include this in their contract price. So the idea is that you shouldn't have to cough up extra cash out of pocket if there are minor overruns.
Okay, so a 10% cushion is part of the loan structure itself. That's a good safety net.
It seems like it. And the last potential issue mentioned is missing those required inspections before each draw. Skipping them means you lose that critical verification step, ensuring work is done right before payment goes out.
But what if costs go way over, even beyond that 10% contingency? Like if lumber prices suddenly skyrocket halfway through the bill.
The sources are very direct about this. If the final cost to build exceeds the total approved loan amount, including the contingency, that extra amount is handled as a change order. And you, the borrower, have to pay that difference directly to the builder out of your own pocket. The loan amount itself cannot be increased after you close.
So that 10% is the absolute limit the loan covers for overages. Anything more is on you. That's a really crucial point. Okay, there's also this slightly complex but really important detail in the sources about paying the loan down or paying it off early. Can you break that down carefully?
Yes, this is definitely a nuance to understand. According to the material, yes, you can make extra payments towards the principal after the loan converts to the permanent mortgage. Maybe you sold your old house, got some cash. However, and this is the important part, the sources say the loan is not automatically recast, meaning making a big lump sum payment towards principal does not automatically lower your required monthly payment. Your balance goes down, which is great, saves interest long term, but you'd still be making that original higher monthly payment unless you formally refinance later.
Okay, so paying it down reduces debt but doesn't immediately change the monthly bill. Got it. What's the other side of that? Paying it off completely.
Right. This is where it gets really specific. If your plan involves paying off a huge chunk or the entire loan balance immediately when construction finishes and the loan converts, well, the sources state there's a significant bank penalty for doing that with this specific one-time close loan product.
A penalty for paying off your mortgage right away. That feels backwards.
Yeah.
And like something that could really catch people off guard.
It's very specific to that moment of conversion on this particular loan structure. The material suggests if your goal is to pay it off in full right at completion, you need to either use a different loan type, like a two-time close to avoid the penalty, or you'd have to wait at least 8 months after the loan converts to the permanent mortgage before you could refinance it to a lower balance without triggering that penalty.
8 months minimum wait after conversion to refi penalty-free.
Okay, so how can you pay it off without a penalty eventually?
The sources state you can refinance or pay off the one-time close loan completely with no bank penalty after you have made at least 6 full monthly payments on the permanent mortgage. So 6 payments after the house is finished and the loan has converted.
6 payments post-completion? That's the magic number, according to this material, to avoid the early payoff penalty. That is incredibly specific, but vital info for planning.
Absolutely critical. Knowing these detailed rules, especially around payments and payoffs, helps you manage expectations and finances effectively, avoiding nasty surprises.
Okay, we've covered a lot. What it is, how it works, the pros, the rules, the timelines, the potential pitfalls, these payoff nuances. For someone listening who's digested all this detail from the material you provided and is thinking, yeah, this VA one-time close thing sounds like it might be right for me, what's the practical next step?
Well, the material you shared points them directly. It provides a contact number specifically for inquiries about this program, 888-857-8041.
And they manage this whole thing remotely. How does that work logistically when you're building a physical house somewhere?
They explain their process relies heavily on today's tech. Initial applications, communication, sending documents that's mostly electronic or fax. For things needing a physical presence, the closing itself can be done with a mobile notary who comes to you or at a local title company office. And for those crucial construction inspections and the property appraisal, they use local HUD-certified inspectors and appraisers in your area. They call them their eyes and ears on the ground, ensuring local expertise verifies everything.
And the logic behind that mostly remote model?
They state it's about efficiency and cost savings. By not having physical bank branches everywhere, they reduce overhead. And they say those savings benefit the borrower.
Makes sense. Do these folks only handle these specific construction loans? Or can they help with other types of home loans too?
The material indicates these construction loan specialists also handle remodeling loans. And the bank itself offers a wider range of products beyond just new construction. Things like standard purchase loans and refinances for existing homes, conventional FHA, VA, USDA, plus jumbo loans, and even bank statement programs for buying existing properties.
So it sounds like they position themselves as construction experts, but within a larger full-service mortgage operation.
That seems to be the picture painted by the information provided, yes. Specialists for the build, but part of a broader lending institution.
Well, this deep dive into your source material has been really eye-opening. It definitely clarifies how this VA one-time close loan is structured as a unique option. A streamlined path, potentially zero down, specifically for eligible veterans wanting to build their own home.
It really does. Combining those financing steps, offering perks like that rate conversion timing, and potentially zero interest during the build, it certainly presents a different approach than traditional construction financing, based on what's in these documents.
And just to reiterate for you, the listener, everything we discussed today was pulled directly from the articles and FAQs you shared with us. We just helped unpack it all.
Exactly. And maybe here's a final thought for you to chew on, based on everything we've just discussed from your material. How does having this deeper understanding of the nuts and bolts, the draw process, the property exclusions, those specific payoff rules for one-time close products, how does knowing that change how you think about tackling what might be the biggest financial project of your life? Does understanding these nuances empower you to ask different questions or plan your approach in a new way? Something to consider.
If you found this video useful, make sure to like, share, and subscribe for more construction loan tips. Just call us at 888-857-8041 or contact us in the link below this video. That's 888-857-8041.